Chinese government really out of money. As the world's second largest economy, China has been facing a string of financial challenges in recent years, particularly with its debt-laden local governments. In this video, we'll look at the unusual world of urban investment bonds, the wave of unpaid wages, and the Chinese government's attempt to keep its financial system afloat. Join us as we discuss how these problems might affect China's economic growth and its place in the world's financial scene. China's push to boost the economy this year by raising infrastructure expenditure while avoiding financial risks is being hampered by vast local government debt, which exceeds $9 trillion and is still growing. As debt commitments grow, some local governments are pressuring banks to prolong maturities and lower interest rates, according to sources. According to Fitch, local government financing vehicles, or LGFVs, have 5.5 trillion yuan, or $790 billion, in onshore bonds due this year, the most since 2021. Concerns regarding LGFV's ability to pay debt obligations and the impact on the larger banking sector and markets have been fueled by a dramatic reduction in income from traditional land sales and fewer possibilities for borrowing fresh financing. As LGFVs play a key role in funding infrastructure projects, which are one of the most important growth drivers for the world's second largest economy, the ability of fiscally stretched local governments to follow through on spending will also be a key test for China's modest economic growth target of around 5% this year. So far, there have been no public stories of an LGFV not paying back a loan, but some have gotten their loans extended. The LGFVs have developed into a major flaw in the Chinese financial system, according to Andrew Collier, managing director at Orient Capital Research. They have been utilized to fill the gap that exists between the revenue and expenditure of the local government. According to him, they have very little or no profit, and they are unable to pay back the debt that is owed to them. I anticipate that many LGFVs will fail or be quietly recapitalized by banks, putting some rural banks and bondholders at risk of default. According to a report published by the International Monetary Fund, or IMF, last month, the total debt of China's local government financing vehicles has increased to a record 66 trillion yuan, or $9.5 trillion, which is the equivalent to half of the country's economy from 57 trillion yuan last year. Concerns about their deteriorating credit profile arise as the government attempts to lift the economy out of the grip of a property debt crisis that has seen a number of developers default on their debt and land sale revenues plummet, forcing Beijing to implement a slew of supportive measures. LGFVs are under considerable debt repayment pressure this year because their income is often associated with real estate and land sales, said Wang Tao, chief China economist at UBS. When delivering the government report, Chinese Premier Li Keqiang highlighted preventing diffusing local government debt risks as one of the government's primary goals for the coming year. The focus comes as some Chinese banks with exposure to LGFVs are increasingly being asked to extend their near-term maturities by up to 6 months and lower interest rates, according to 3 sources familiar with the situation. Due to the sensitivity of the situation, the sources who declined to provide specifics could not be identified. In recent years, Chinese banks and other financial institutions have been wary about new financing for LGFVs. Separate financial sector sources told Reuters that in recent months, certain state-owned banks, asset managers, and insurers have begun looking into their portfolios to screen and dispose of LGFV borrowers with poor creditworthiness. According to the rating agency S&P, local government finance vehicles were forced to raise a record $39.5 billion via dollar bonds in 2017 as a result of stricter credit standards in their home markets. According to sources within the business, a significant number of the bonds were purchased by overseas branches of Chinese financial organizations. However, since late 2022, regulators have increased their supervision of the LGFV dollar bond issue. According to two different people with knowledge of the situation, the National Development and Reform Commission, or NDRC, did not grant requests from organizations that have lower credit ratings as part of its attempts to reduce the risks that are present in the financial sector. Requests for comments were not immediately responded by the NDRC or the China Banking and Insurance Regulatory Commission. Fitch Ratings stated in a research last month that worsening in capital market access can increase refinancing risk and deepen the liquidity constraint for the LGFV sector, adding that units in less economically developed regions are especially vulnerable. The deteriorating prognosis for LGFVs has also caused several shadow banks, which are financial institutions that provide loans to industries that cannot get bank funding directly, to be concerned about their exposure to such units and reluctant to provide new loans. According to Alicia Garza Herrero, the head economist for Asia Pacific at Natixis, LGFVs used to be financed in the shadow banking, but increasingly it has moved to the onshore bond market and in some cases offshore. It appears to me that a number of projects, particularly offshore ones, may default with consequences for bondholders. According to some analysts, Chinese authorities would prevent large-scale defaults by LGFVs because they would make debt market access more difficult for both public and private issuers at a time when attempts are being made to resuscitate the economy following the repeal of 3 years of draconian COVID-19 measures. LGFV debt as a percentage of GDP is still manageable at this point. The essential concern is to slow the rate of expansion and avoid default, which might cause a market panic. According to a source familiar with the arrangements, China is set to withdraw its insistence that multilateral development banks share losses with other creditors in sovereign debt restructurings for impoverished countries, removing a major hurdle to debt relief. In Washington, there will be a high-level state debt roundtable as part of the World Bank and International Monetary Fund spring meetings. This is where the news is likely to come out. The source said that Beijing would no longer demand that multilateral lenders take haircuts on loans to poor countries. The IMF and World Bank also agreed that their analyses of the debt sustainability of countries going through debt restructuring would be shared with Chinese authorities earlier in the process. At an event during the meetings, IMF Managing Director Kristalina Georgieva said that the fund had agreed to give bondholders information about debt sustainability earlier so that they could better prepare for restructurings. She also said that the World Bank was being asked to show how it could be a net positive source of capital and concessional loans. The IMF, the World Bank, and the U.S. Treasury have all told Beijing that giving concessional loans to countries with a lot of debt is the same as letting loans go bad. Georgieva said at the Bretton Woods Committee event that, "So far, I'm hopeful. I hope to still be optimistic after our meeting tomorrow." Thank you for tuning in. If you found this video useful, please like it and subscribe to our channel for more thought-provoking stuff. Also, if you have any ideas or opinions on the topic, please share them in the comments section below.